colleague, John Hagan, and to get some more details, if you will, about these particular strategies. But it stems to um, the volatility and the fact that, as this slide shows you, declines are going to happen. Now, this looked at the same thought, the price of admission, in a different fashion. This is a slide put together from 314, and it keeps it simple. Right in the middle of this slide, we've got two graphs here, if you will. We've got the purple graph with the S&P 500, and we've got the aqua blue, if you will, graph also of the S&P 500. And the point is, after a 10% decline, if there is no recession, that basically historically means that a buying opportunity exists. Now, this slide shows you that once you see that 10% decline, doesn't mean you can't go down 12%, doesn't mean you can't go down 14, 15%, but net, if there is not a recession, the majority of the decline is already behind you. The key factor also, again, with the purple line is if there is a recession, the weakness continues and the environment gets much more difficult. So the takeaway from our perspective, from Dave Hagan's perspective, is within the fact that we just had a 10% correction, the recession card, if you will, and I say that in quotes, that has not shown up in our model deck. So right now, our models are not calling for any type of recession. And I'm going to also refer to this again with slide number 8 and slide number 24. But again, the price of admission declines, and one of the key factors going forward is whether we're going to be in a recession or not. If there's no recession, the majority of the decline is behind us, and that's what I want to point out with this slide. Now let's look over the wall of hope, if you will, on the left, or the green shoots, or the wall of worry on the right, which is the headwinds, if you will. And a number of these bullet points, and I'll just briefly mention them, and I'll back some of these up with charts, and most of these I've talked about in my Tech Talk report, so I'm not going to have charts on these particular points, but I do want to discuss them. And first off, the new lows. We had a positive divergence with the new lows when the S&P recorded its recent decline on March 13th, and let's just call it a recent reaction low. On that day, while the S&P trended or set another low, the internal selling pressure had peaked days ago. So while the S&P sent that reaction low, the number of new lows was less, and that's a positive divergence. And the same positive divergence showed up with the AD lines. The S&P recorded a new reactionary low on March 13th, yet the AD lines on the New York and the AD lines for the S&P 500 did not record a new low. They recorded actually a higher trough. And what that told you is that the selling pressure, while it was tough to stomach because it was in the major averages that we look at and see every day, the internal selling pressure had already reached its maximum a couple days ago, a couple days prior to that. In terms of sentiment, bearish for the most part across the board. And as a contrary indicator, that's what you like to see. I will show you a chart of the purge that took place in the high beta complex, and that is something that I had featured in my Tech Talk report as well. We had consecutive 80% up days, and a 10-to-1 up day, meaning 80% up days. The advancing volume on the New York Stock Exchange was 80% of total volume for 2 consecutive days. That is traditionally bullish, in that it at least helps you set a low and establish an important support level, and it also can be termed a momentum thrust. Also, underneath the fourth bullet point, the downside price target of the S&P 500 was reached. In my Tech Talk report, in one of them, I pointed out the topping pattern that took place, and I showed you how I derived a downside price target, and that price target was 55.10. Well, the S&P on an intraday basis on March 13th got down to 5504, if I remember correctly, and on a closing basis, it got down to 5521. So basically, the downside price target was achieved. Following that, which established a support level, we got those consecutive 80% upside days, or a momentum thrust. The next bullet point that I call a green shoot is global participation. And that's just simply saying that there has been some relative outperformance away from the US. This is not new. I'm sure you're well aware of this by now. It's been spoken about and discussed ad nauseum. But the nice thing about that is that's telling you that money's not leaving the market, it's simply rotating around. And that also happened on a sector basis. Money has been rotating around into the defensive areas, the healthcare and the consumer staples and utilities, out of the communication services, out of technology, out of discretionary. Now we're starting to see that rotation flip, which is making things interesting. You look at today and you see the healthcare, the relative strength of the XLV, the relative strength of the XLP, which is a consumer staples, is weakening. So you're starting to see that rotation take place again. And again, rotation occurs when money is not leaving the market, it's just finding a new home, both on a sector basis and, to bullet point number 5, on a global basis between the US markets and overseas markets. Commodities, I consider this a green shoot. On a selective basis, they have offered plenty of opportunities. We've talked about lumber, we've talked about natural gas. I haven't talked about gold in quite a long time, simply because everybody on Wall Street has been recommending gold. I've talked about silver, I've talked about copper. So there are opportunities, and I will go into more details with copper towards the end of the presentation. So selectively, I consider that a green shoot, that there are areas, again, that money is rotating to and it's not leaving markets. From a seasonality standpoint, we're entering a favorable time seasonally, early to mid-April, and I'll show you a chart of that. In terms of on the right side, the headwinds, or what's a drag, is the price trend. I mean, that's pretty obvious, and the tops had been completed. The question now is the bottoming process, which we'll get into in a bit of time, but I put the trend as being a headwind simply because now there's so much locked in overhead selling pressure that needs to be chewed through. I don't think it's going to be this straight down, straight up type move, sort of like the way we came off of the COVID lows. We came down in a V bottom. I think it's going to be more choppy and more base building in light of our what's going on with domestic politics, with geopolitical tensions, etc. I think it's going to be choppy for longer. But that overhanging selling pressure that came as a result of these completed tops is a headwind. The index movers, the Mag 7, I hate to use that term because they haven't been magnificent for 8 to 9 months. They were clearly under distribution. Now they're starting to see some rotation there as well, which I'll get into. But the fact that you had the index movers under distribution, that was a headwind. And like with the price tops for the major indices, the distribution with the index movers also locks in overhead selling pressure. Bitcoin, which is really the poster child, if you will, for risk on, risk off, topped. It completed a top, but I will say, interestingly, it did hold slightly above long-term support around the 75,000 to 70,000 area. So that's your downside level that you're watching. The reaction low that it just recorded a week or so ago, but really that 75,000 to 70,000 is important downside support for Bitcoin. And on the upside, you've got previous price peaks and downtrend lines in the 90 to 93,000 area. I do not include a chart in this presentation of Bitcoin, so reach out if you're interested. Another headwind, again, from a psychological standpoint, is just the U.S. underperformance. It takes people time to accept the fact that other countries and other overseas markets are working. So I have that as a headwind simply from a psychological standpoint. Domestic politics, nothing that I can say there. The uncertainty, the economic policy, tariffs, trade wars, whatever, that creates uncertainty. Geopolitical tensions, everybody seems to be talking about it, but I ask here, in all truthfulness, when does this not exist? There's always geopolitical tensions, but nonetheless, that can be a drag. And interest rates now. I've got the long-term trend. I'm going to be showing the 1 year trend of interest rates, but if I was to show you a 40-year trend of interest rates, I still think that we're going to see higher interest rates down the road. From a timing standpoint, we've been range bound for about a year, and that's what we'll deal with. But I do believe from a long-term, in terms of a drag or a headwind, long-term interest rates are a headwind. Now, I really want to stress these bullet points. I don't include charts on a lot of those previous points because I think on the margin, these bullet points are really more important and for us to focus on. How they're resolved, I think, will play a major part in the domestic equity market's next significant directional move, coupled with, of course, what the catastrophic stop loss does. So green shoots or a drag, these could go either way, and they all need to be monitored closely. And I will address charts with each of these. Credit spreads, they're below a long-term downtrend line, but they have been widening. The index movers, as I mentioned, big picture, they were under distribution. Now they've started to show some basing patterns. Do they stair step higher slowly, like a rehab patient? Any type of cardiac rehab patient has to take their time getting up and running again. They just don't start running right away. They have to rehab and slowly and steadily get in better shape. And that's what has to happen with the index movers. Or do they continue to work lower? Inflation, stable to lower inflation, which obviously is not technical, but that's positive. But I think where inflation goes moving forward is going to be dictated by crude, and I'm going to show you a technical chart of that and show that relationship in a second. The bottoming process, the W pattern, is critical. Again, slow and methodical. We first discussed this a week or so ago in the Tech Talk report, and so far that pattern has played out. And finally, bullet point number 5, and I just have to put this out there as a responsible analyst, and it must be acknowledged. One of my former colleagues and I always used to say, what's the worst case scenario and what's the least likely scenario? And I think that at least needs to be addressed as a responsible analyst. So we'll talk about that as well. So here is the chart in terms of the credit spreads. And you can see that this chart is the Bank of America U.S. High Yield Index option adjusted spreads. And you can see the chart goes back from 2023, and you can see down in the lower right corner of this pattern, you see a nice basing pattern, and you've seen it break topside. Now that's bullish, meaning credit spreads are starting to widen. And when credit spreads start to widen, that is indicative of stress increasing within the financial system. So, and you started to see that started occurring prior to this whole decline, but as these accelerated and widened, you could see the sell-off in equities quicken. So that, first off, from a short-term standpoint, is concerning. I've got on there the rising 50-day moving average. I've got the curling 200-day moving average on there. But more importantly than that short-term pattern, which again was completed, which is bullish for spreads, which is negative for the financial backdrop, is the fact that the long-term downtrend line has not been broken, and that's the red downtrend line. So the takeaway from this slide, and really, the bulls don't want to see this red line decisively moved above or stabilization above that resistance line, because if that does occur, that would again be indicative of financial stress in the financial system increasing. So the takeaway is, will credit spreads give credit to longer term trend line resistance. So we'll keep monitoring this. I would suggest if you've got the ability to monitor this on your own, but I think there's a few critical takeaways in this presentation. I think this is one of them. I think crude oil and whether it breaks down or breaks to the upside is another one because of the implications with inflation. And another critical factor to this entire presentation has to do with sentiment, which we'll get into in a minute. So here is a chart of the MAGs, if you will, the Roundhill Big Tech ETF, which is a representation, or what I've been using as a representation of the index movers. And you can see, and this is a chart that I featured back in February when it was breaking down on a relative basis, and that was a clear head start to what was to come in terms of the distribution. But you know, that's after the fact. I think that this needs to be monitored. You can easily monitor this with the symbol MAGS on your quote system. And you can see right down here where my cursor is on the right. And I've also included, and you'll see this in a number of other charts, you see these little charts to the right, these little thumbnail charts on the right. I show those because they help really make it easier for you to discern the support levels or the resistance levels. So you can see that 46-ish, 46 and a half area downside support, which the bulls want that to hold. And you can see the little breakout, that little base that occurred. One of these signs of a trend change is intraday volatility, but also day-to-day volatility. And you can clearly see we saw, following this nice downtrend, this rounding top and downtrend, you saw day-to-day volatility, which is base building, and a small break to the upside. So, you know, we need to monitor this closely. Do they continue working their way higher up towards resistance up in that low 50 area, or do they break lower? So again, stability and base building, like, you know, is good for the cardiac patient, or a false breakdown that's bearish. That's why I think this was one of the bullet points I think we need to focus on, because it will be play a big role in dictating the direction of the indexes. Now, this is a slide that talks about the relationship between crude in the upper slide and the Pring inflation index in the lower slide. And it really has to do with, you know, drill, baby, drill. And, you know, if, as President Trump says, he's going to allow these companies to drill and more energy or more oil comes out onto the market, in theory, that should lower prices. That should cause crude oil to break down and go lower, which should be helpful for inflation. And what this slide is showing you is, by and large, inflation, the lower frame, and crude oil, the top frame, they tend to move together. It's not ideal, it's not always, but generally speaking, you can see the influence that crude oil has on this inflation index. And right now you can see where those blue arrows are under the crude oil chart, again, upper frame, you can see that important support area in that 65, 67 area. And you can see that again by the thumbnail chart over to the right where my cursor is right now. So if crude breaks down, if drill baby drill does lead to a breakdown in crude oil, again, under that 67, 65 area, that should have positive implications for inflation. And you can, again, see the correlation between the upper frame and the lower frame. And that should be helpful in terms of psychology. That should be helpful in terms of the Fed and what they're concerned about inflation, and that should help markets overall. On the flip side, it is important to see that that price peak in crude around $76 would be violated, and at that point, a downtrend line, which I've also drawn in the upper frame, top frame for crude oil, if that gets violated, that's going to put pressure on inflation figures, and that would cause some concern. So once again, I think crude oil is a very important component, or a very important commodity for us to follow going forward in terms of psychologically with inflation, with the Fed, and with the major averages. Now, in terms of the cardiac patient rehabbing, they go through, in terms of the market, rehab, a W pattern, or a low rally retest sequence. And this is something that I had talked about in my Tech Talk report. And normally, the bottoming process, the low rally retest sequence, the W pattern, whatever you want to call that process, normally has 4 steps. And it in our case now, in terms of a bottom, you look for it to develop after a decisive downtrend, and clearly we've had a decisive downtrend. The first step of the 4 steps is an oversold condition, and we clearly got oversold. We had a purge of the high beta complex. So I would say, in terms of step number 1, check. In terms of the second step that you like to see in terms of this bottoming process is a rally. And you want to see it for more than a day or two, because normally, the first rally for the first day or two off of that sharp downtrend tends to be more short covering. So you want to see more than 1 or 2 days of consistent topside probing. And again, that's an element. The intraday and the day-to-day volatility is an element to this process, and I would say check to step number 2. Now, number 3 is the third step is a retest. On a successful retest, market indices may or may not breach their initial lows. More importantly, the successful retest shows less selling pressure, and the less selling pressure, as I alluded to on the beginning of this presentation, in one case can have to do with fewer stocks making new lows. And that's exactly what happened back in a week or so ago, a couple weeks ago, I guess now, March 13th versus, a few days prior to that low. The AD lines, you see higher AD lines, that happened. A higher percentage of stocks above certain moving averages. You see less total volume. You see less downside volume versus upside volume. So on a short-term basis, and I'll show you this retest process in a couple of the index charts, I'm going to say short-term, yes, but I really want to see a larger body of internal improvement take place. Today, when I was looking at the market towards the end of the day, while the S&P was flat, again, I don't know where it closed because I opened up this presentation before the market closed, but the internals were not good. There were more declining stocks than advancing stocks. So I need to see a larger body of internal improvement. But net on a short-term basis, I would say check to step number 3. And then the fourth step has to do with breadth thrust. Now, we've had one, and I mentioned that on slide number 3, that those 80% back-to-back 80% days, but ideally you like to see a cluster. You like to see 3, 4, 5 different breadth thrusts. And we measure about 10 or 12 different, we have 10 or 12 different ways of, quote, defining a breadth thrust. And one of them is that having to do with volume. So we've met one. And at worst, this has helped identify critical short-term support. That March 13th low, I think, is critical short-term support. It was locked in by that one momentum thrust, if you will. So I'm going to give this a partial check because we really want to see a cluster. More work is needed. So bottoming is a process, and while we're working through the necessary stages, the burden of proof still rests on the process. So here's a chart, again, playing the worst case scenario, okay? As a responsible analyst, this should be recognized. And, if there are future retests of the price lows and they're unsuccessful, and again, an unsuccessful retest is defined by a material violation of the previous lows and expanding new lows, more declining volume than advancing volume, etc., then you have to be aware of what is the potential downside. So if the bottoming process, if the retest fails, the bottoming process starts back at step 1, but you've got to look at downside. So right where my cursor is, you can see that 5521 closing level. Downside supports 5400. But again, as a responsible analyst, recognizing the worst case scenario, what could it be? It could be anywhere in this, 5,000 give or take area, 4,800 area. So again, I think it's important just to recognize this. Now, in terms of your U.S. versus overseas allocations, the question or the takeaway here is, and these are the 2025 performance for China, and you can see I've labeled Germany, Switzerland, Japan, Canada, and also the US, the S&P 500. And I ask, how are you positioned when it comes to the US versus your international allocations? And again, this was through last Friday, so this did not include yesterday, did not include today. And these particular countries, China, Germany, Switzerland, Japan, and Canada, were rated overweight as part of our core exposure in our smart sector international ex-US. So I just want to point out to you that that strategy has done a good job of recognizing the countries that have performed well on a year-to-date basis. Now, I think that this strategy will complement your efforts in terms of discerning US versus international allocations. The models will update next week on April 1st. No April Fools there. The models will update. And I would ask you to reach out and learn about the features and benefits of this strategy. Part of the reason, and I have a little note down here, why are we seeing such outperformance by these overseas markets away from the perception of what's happening in the United States, tension-wise, domestic-wise, has to do with the dollar. I mean, the weakness in the dollar has helped these overseas markets as well. This is the explore side of the strategy. You have a majority of the allocation towards the core countries, the major international countries. And then you have the explore side. And these are countries that just for the month of March were rated overweight. Okay. And this is the performance just from February 28th through March 21st. And you can see India was in overweight, Chile was an overweight, Thailand was an overweight, Taiwan wasn't overweight, and Israel wasn't overweight. And then there's the US down in the S&P 500. And you might look at me and you say, Art, sure, India and Chile and Taiwan, they were positive for the month, but Taiwan and Israel they were down for the month. And I say you're exactly right, but they still outperformed the US. So again, I just want to point out to you and ask you, how are you positioned when it comes to US versus emerging allocations? And let the smart sector international ex-US strategy help complement your efforts in that area. In terms of sentiment, again, sentiment is a second tier indicator. We use it in conjunction with our other models. It is part of the catastrophic stop loss model. And I've got a couple bullet points here. Wall Street strategists entered 2025 in the most bullish positioning in decades. After 23 and 24, they came into 25 in the most bullish position in decades. And then here you see, after this correction, RBC, Goldman, Deutsche Bank, and JP Morgan lowered their outlook for 2025. So they came in, they were wrong, and now they've lowered their positioning. Could they be wrong again? Newsletter writers are bearish, and short-term sentiment measures show pessimism is rife within the markets. And this particular survey, this came out from Bank of America, it's their global fund manager survey, and you can see that the fund manager survey shows the biggest drop in U.S. equity allocation on record. And again, I think sentiment, this whole presentation, I have the key takeaway here to all of this. And when I say all of this, I mean this presentation is we really need to see what sentiment does on the rally. Do they fight it, which would be very bullish, or do they embrace the rally, which would not be bullish? I also would love to see how sentiment shifts and how the market reacts to April 2nd, Liberation Day, if you will, or if President Trump makes some more comments, tweet-wise, media-wise, about tariffs, I think how the market reacts to those particular occurrences will reflect sentiment as well. So again, crude oil, I think, is important. Sentiment, I think, is extremely important. This is a chart this is an old chart, and this is a chart that I showed in my March 12th Tech Talk report. I did not update it. I purposely didn't update it because I really wanted to show you the purging that had taken place in the high beta complex, the oversold nature that took place in the high beta complex, and the rate of decline, again, another way of saying the purging in the index movers that took place in this particular index. So you can see that in the upper frame, that's just simply an overbought, oversold indicator. And you can see that it had reached oversold levels. This relationship between high beta and low beta reached levels comparable to the COVID lows. In the middle frame, this is the relative strength line again of the high beta proxy versus the low beta proxy. And when the line is falling, high beta is underperforming, and you can see it was clearly underperforming. And look at that cascade or that waterfall decline in the middle frame. It came right down to some support. And in terms of the 14-day rate of change in the bottom frame, you can see that there was so much purging in this particular relationship, it got down comparable to the COVID lows again. So again, evidence that hedge funds had degrossed, if you will, momentum positions, high beta purge. It may have run its course, but at least that was part of the process of setting the low. That is part of step number one in the bottoming process of being oversold, because at the same time that this was occurring, the S&P traded over 3 standard deviations below its 50-day moving average, and mathematically that is extreme. So again, I just wanted to point this slide out to you again when we were talking about oversold on step one of the bottoming process. From a seasonality standpoint, now this is a condition, and seasonality is not part of any of our models. But you ask the question, which direction is the train likely to move? And if you have that, if you will, simple question in your mind, and then that's where seasonality can help you see what may occur or where the odds are what may occur. And you can see that this seasonality has been spot on for the month of February and March. By that red box, you can see, and we are coming out of the seasonally weak, choppy period and now starting to enter a favorable season. So I would say from a seasonal standpoint, we're entering a favorable period. This is just a couple miscellaneous trends of interest. You've got the home construction index in the upper frame. You've got the bank index in the middle frame, and you've got the semiconductor index in the lower frame. Now, I've tried to show, and again, I've shown the little thumbnail charts on the right so you can discern the price levels, those recent lows, so you get a better idea of where support and where resistance is. What I do find interesting on the home construction chart is that this index barely moved today, despite the report from KB Homes. So KB Homes itself was down hard, but the home construction index barely moved. So I find that interesting. The bank index, you obviously like to see the market move with the financials and with the big money center banks. And you can see the recent low came right down to some support. That trend line drawn off that February 24 low, it's a good complete trend line. So you've got some good support for the bank index. It broke topside yesterday. I like to see it get above and stay above these green support lines. And finally, the semiconductor index. You can see it's hard to believe with all the hullabaloo about NVIDIA and the semis and AI and quantum computing, et cetera, that the semiconductor index is basically at the same place it was back in March of last year. And I've tried to point out to you the support, the green line, and the important resistance line. And you need to get above that and stay above that red resistance line in order to see some improving action from the semiconductor complex. Trends are up, trends are down, trends are sideways. Now, I hate to even give Russia credit for anything, but the quote from Vladimir Lenin, I think, is very appropriate when it comes to the domestic stock market over the last 6 weeks or so. There are decades where nothing happens, and there are weeks where decades happen. And that sure lasts 4 to 6 weeks, a whole lot has happened. So there's some bullet points there that I think are important to be aware of. I'm not going to go over. What I will go over is bullet point number 3 is be cognizant of retracement percentages of a decline. That helps you discern resistance levels, 1/3, 1/2, and 2/3. And I say that because with those completed tops, there's still a lot of overhanging selling pressure. So it's important to discern the selling pressure, and it's important to discern those retracement levels that might bring out some additional selling pressure. Bullet point number 4 is just simply those closing lows. So those are some support levels for the Dow, the S&P, and the NASDAQ. And again, something that I feel very strongly about, and that is choppy for longer in light of the reasons that I've already explained about the topping patterns. Now, retracements. I put here, what you talking about, Willis? What do you mean by replacements? Art, what you talking about, Willis, if you remember the different strokes and the fact that Arnold would always say that to his brother. And this is a slide put together from 314, and it talks about once a correction retraces 50% of the sell-off, there's an 81% chance that the sell-off is over. Now, we know you can make numbers say anything that you want, but I did think it was interesting, and you'll see I've shown you, I figured out the 1/2, the 50% retracement level for the S&P. You can see it over to the left of the slide, 58.32. Again, that's a 50% retracement of the decline, and it actually corresponds with some resistance, which we'll see in just a second. So takeaway based upon this particular slide and the fact that, as I alluded to in the beginning with the price of admission, we do not see a recession on the horizon yet. That's not in our slide deck. The recession card has not come out of our slide deck yet. So based on this slide, odds that the worst is behind us improve as the correction retracement moves higher, meaning if we get above that 58.32 level for the S&P 500. So here is the S&P 500. And despite the rally, again, there's a lot of overhanging selling pressure across the board, and it's going to take time to work through it. And that's the real takeaway. Again, choppy for longer. And you can see I've highlighted with this blue circle on the S&P chart, the 50% retracement area. Again, I refer you back to the previous slide, and that's at 58.32. And look at how that corresponds right with other resistance levels. So yesterday's high was some resistance. We stalled there today, the thinner red line. And then you've got the thick red lines as resistance and trend line and 50% retracement level. And I also have shown you that March 13th low where those blue arrows are, that's support, less selling pressure when that low was recorded on March 13th. And over in this thumbnail sketch to the right, again, you can see the day-to-day volatility, okay? Again, part of at least stabilizing of a downtrend. And you can see the retests that took place from a price standpoint. So on March 13th, on that low, there was less selling pressure than what you saw a few days prior to that. Then you had the sharp rallies. Then you had the one pullback where my cursor is right now on the left side of the blue box on the thumbnail chart on the right. And there was less selling pressure there than what you saw on March 13th. You rallied. You pulled back. Now you had a big intraday swing, but on that pullback, again, there was less selling pressure. So that's sort of an example of the retest process for the S&P. There's the important resistance levels in red and the support levels highlighted by the green horizontal line, as well as the figures pointed out in the thumbnail chart on the right. Here is the Dow upper frame and the Dow transports on the lower frame. Again, you see how long it took for these twin peaks to develop. I think the whole low rally retest sequence and bottoming process is going to take time as well. We're going to see volatility in both directions. The thumbnail chart on the right again show the support levels for the Dow Industrials, and it also shows it for the transports in the lower frame. So again, the 50% retracement level I have also highlighted for the industrials comes in right around that area, right around that, call it 42,750 approximately. Here's the NASDAQ composite. Again, look at the, I did not figure out the 50% retracement levels just because it takes there's a lot of overhead to chew through here. There's the resistance shown in red. Notice how that support, and I showed this chart support in a Tech Talk report prior to this developing, but you can see that green downward sloping trend line is support. It caught it, it held. You can see the thumbnail chart on the right, the back and forth, day-to-day volatility. Again, following a decisive trend, one sign of a trend change is price stability in the form of day-to-day volatility. So again, there's the NASDAQ with your support levels as well as your resistance levels. And here's the small cap proxy. I expect a lot of volatility here as well. So you can see the resistance, the 50% retracement of this, I believe, is somewhere up in that 220 area. 50% retracement of this entire decline is around 220. And again, that corresponds right with the moving average, and it corresponds with this red trend line, resistance line. Here's the 10-year yield on the upper frame, symbol TNX, and the 20-year Treasury bond ETF, or the price proxy, if you will. And you can see that we've moved sideways with interest rates for over a year, and we've also been choppy over the last, since last December, last fall, if you will. So you can see important support for TNX, or for the 10-year, in that 41.80 to 41.5 area, and you can see the bottoming process on the TLT. If TLT does happen to get up over 92, 93, that would be indicative, or that would only occur with lower interest rates, and that could give you a trade higher. So I think it's important to watch the 41.80, 41.50 support level for the TNX. I think it's also important to watch these resistance levels as shown by the horizontal red lines. Again, we're talking about the upper frame, and also the resistance for TLT in the lower frame. Here's the US dollar. A near-term rally wouldn't surprise me, and I say that because in the upper frame is the momentum indicator, the MACD, and you've just had a bullish cross. In the lower frame is the US dollar index. It's stabilized at support as well. It's also moving sideways, laterally building base, and with this positive cross from a momentum standpoint, I wouldn't be surprised to see some upside probing in the dollar. That might cause the overseas markets to pull in a little bit, and it might lend itself to some relative strength for the US market. So again, given the relationship between the US dollar and overseas markets, I would encourage you, if interested, and depending upon your overseas allocations, reach out about our Smart Sector International strategy. Here's copper. Despite all the economists and what they're saying, a recession, increasing their odds of a recession, a downturn is imminent. You look at copper, and you've got copper fund on the upper frame. In the third frame down, you've got the copper contract, the futures contract with momentum above it. Again, this is weekly charts. And in the lower frame, you've got the copper versus the gold relationship. So the takeaway here is bullish chart configuration continues with copper. And the copper sentiment is excessive. It's in the excessive optimism zone right now. I point that out according to NDR. So some type of pause or pullback would be healthy and viable. But in terms of my comments earlier about copper, having featured it a few weeks ago at lower prices, I wanted to bring it to your attention again because it continues to act very well from a chart perspective. In closing, and these are just some thoughts. Watch for a narrative shift in how equities react to the said shift, or the April 2nd Liberation Day news. Again, I think sentiment is so critical, and everybody is on edge about the announcements. Let's see if there's a narrative shift. But again, when there is or isn't, how do equities react to if there is or if there isn't come April 2nd. Again, the smart sector strategies may complement your efforts during this waiting period and beyond. Crude oil seasonality, I did not mention or did not show a chart, but I wanted to mention that it is entering a bullish time period. The month of April is historically favorable for crude oil. Reach out for the chart. And there's a couple more quotes there that I think would be of interest if you're, I loved Helene Meisler. Market isn't a sofa. Don't get too comfortable on either side. Again, choppy for longer. And finally, some final thoughts about our smart sector strategy. And Ned Davis research is famous for saying winners make small mistakes, losers make big mistakes. Currently, the smart sector strategies, the model's message is that the current downtrend doesn't rise to the levels of potentially catastrophic, i.e., match your equity benchmark. That's all I've got. I apologize if I've gone a little long this afternoon, but it's been a while and I had a lot to share. By all means, please reach out to me at your discretion. And as always,
The data and analysis contained herein are provided as is and without warranty of any kind, either expressed or implied. Hagan Asset Management, DHAM, and of its affiliates or employees or any third-party data provider shall not have any liability for any loss sustained by anyone who has relied on the information contained in any Hagan Asset Management literature or marketing materials. All opinions expressed herein are subject to change without notice, and you should always obtain current information and perform due diligence before investing. DHAM accounts that DHAM and its affiliated companies manage, or the respective shareholders, directors, officers, and or employees may have long or short positions in the securities discussed herein and may purchase or sell such securities without notice. DHAM uses and has historically used various methods to evaluate investments which at times produce contradictory recommendations with respect to the same securities. When evaluating the results of prior DHAM recommendations or DHAM performance rankings, one should also consider that DHAM may modify the methods it uses to evaluate investment opportunities from time to time, that model results do not impute or show the compounded adverse effects of transaction costs or management fees or reflect actual investment results, that some model results do not reflect actual historical recommendations, and that investment models are necessarily constructed with the benefit of hindsight. For this and for many other reasons, the performance of DHAM's past recommendations and model results are not a guarantee of future results. The securities mentioned in this document may not be eligible for sale in some states or countries, not be suitable for all types of investors. Their value and income they produce may fluctuate and or be adversely affected by exchange rates, interest rates, or other factors.